James and his coworker Nathan had a conversation in the break room last year that James has thought about almost every week since. Both of them contribute $500 a month toward retirement. Both of them use diversified index funds. Both of them have been doing it consistently for 8 years. From the outside, their financial habits look nearly identical. But James uses a Roth IRA, and Nathan uses a 401k. And when James sat down to actually calculate what that difference means over a 30-year career, not in account balance, but in real money he would actually get to spend, the number surprised him enough to write it down twice. This video is that calculation, not the surface version where one account sounds better than the other, the complete version, including the number most retirement comparisons conveniently skip, how much each account is worth after taxes are settled. Both a 401k and a Roth IRA allow your money to grow without being taxed each year as it compounds. That much they share. The difference is when the tax is paid, and that timing determines something more significant than most people realize. When Nathan contributes to his 401k, the money goes in before taxes are taken out. It reduces his taxable income today. His $500 monthly contribution costs him roughly $390 out of pocket after accounting for the tax savings at his current bracket. That feels efficient. It feels like finding a discount on the way in. But here is what that discount actually represents: a deferred payment. The IRS accepted a delay, not a cancellation. Every dollar Nathan has accumulated in that 401k, the contributions and every dollar of growth on top of them, will be taxed as ordinary income when he withdraws it in retirement. At that point, Nathan will not control the rate. Whatever Congress has set by then is the rate he pays. When James contributes to a Roth IRA, the money goes in after taxes are already paid. There's no deduction today, no immediate relief on this year's tax bill. But the IRS's involvement ends at contribution. Everything that grows from that point forward, 30 years of compounding at whatever rate the market produces, belongs entirely to James when he withdraws it. No further tax, no calculation needed at retirement. The number on his statement is the number in his checking account. One account contains a silent tax liability that will not be quantified until withdrawal. The other does not. Nathan has an advantage James does not: an employer match. His company contributes an additional amount for every dollar Nathan puts in, up to a certain threshold. That match is free money, an immediate return on Nathan's contribution that no investment strategy can reliably replicate. At year 10, Nathan's account balance is meaningfully higher than James's. The employer match, compounded over a decade, produces a real and substantial lead. If you showed both account statements to a financial observer and asked who had made the better decision, they would point at Nathan without hesitation. But that comparison is incomplete. Nathan's larger balance has a tax bill attached to a future version of itself that is currently invisible. If Nathan's effective tax rate at retirement lands around 24%, his apparent lead shrinks significantly when adjusted for what he will actually keep. James's smaller balance, fully his after taxes already paid, closes much of the gap when measured in the same terms. The employer match is still valuable. That point matters, and we will return to it, but the balance comparison is not the complete picture. Nathan got promoted, then again. By his mid-40s, he was earning considerably more than he was at 28. This is a success story. It is also, somewhat unexpectedly, a complication for his 401k. When Nathan eventually withdraws from his 401k in retirement, every dollar is taxed at his income tax rate in that year. If Nathan has accumulated a meaningful retirement balance, the kind that 30 years of consistent saving and compounding tend to produce, his required withdrawals could push him into a higher bracket than he anticipated. Add Social Security income, any pension, and investment income from taxable accounts, and the effective rate on those 401k withdrawals may be higher than the rate he deferred at decades earlier. There is another factor Nathan did not fully account for at 28, required minimum distributions. Starting at a government-mandated age, 401k holders must withdraw a minimum amount annually, regardless of whether they need the income. In years when the market has performed well, those minimums can be larger than anticipated, generating taxable income that was not planned for, and potentially compounding into higher Medicare costs and a larger tax bill on Social Security benefits. James's Roth IRA has no required minimum distributions during his lifetime. He withdraws what he needs when he needs it. Years where he needs less, he takes less. He can let the account compound untouched if his other income is sufficient. The flexibility to control the timing and size of his retirement withdrawals has genuine financial value that no account balance comparison captures. This video would be incomplete without being genuinely honest about what favors Nathan's choice. The employer match is the single most powerful argument for prioritizing a 401k, and it is not a close call. An employer matching 50 cents or a full dollar for every dollar contributed is an immediate guaranteed return of 50 to 100% on that portion of savings. No investment vehicle on earth reliably delivers that in the first year. Choosing to skip or reduce 401k contributions below the match threshold in order to prioritize a Roth IRA is giving up free money, and the compounding of free money over 30 years is substantial. The 401k also carries a higher annual contribution limit. Someone who wants to shelter the maximum possible amount from current taxes has approximately 3 times the room in a 401k compared to a Roth IRA. For high earners in peak income years who expect their tax rate to be meaningfully lower in retirement, deferring income through a traditional 401k can be the mathematically superior choice. The Roth IRA also has income phase-outs. Above certain earnings thresholds, direct contributions are reduced and eventually eliminated. High earners have workarounds, but they add complexity that the 401k simply does not require. These advantages are real, and they belong in any honest comparison. The practical answer emerging from this comparison is not either-or, it is sequential. The first move is contributing to the 401k up to the full employer match. Capturing the match is the highest return available financial action in most people's lives. Everything else waits until this is done. The second move is maxing out a Roth IRA. For someone in their 20s or 30s, likely in a lower tax bracket than their peak earning years, paying taxes now on current income and locking in tax-free growth for 3 decades is a structurally advantageous decision. The earlier in a career this happens, the more compounding occurs on the after-tax contributions, and the more dramatic the long-term difference becomes. The third move, if saving capacity remains after completing the first 2, is returning to the 401k and contributing toward the annual maximum. This sequence captures the employer match, maximizes the period available for tax-free compounding in the Roth, and still allows pre-tax savings to reduce current taxable income for those with additional capacity. James and Nathan both did something right. Nathan captured free money through the employer match and built a substantial account balance that will fund a comfortable retirement. James built a smaller balance that is entirely his without further tax obligation and that he can access on his own schedule without government-mandated minimum withdrawals. The actual dollar difference between their outcomes depends on tax rates 30 years from now, a number neither of them knows. That uncertainty is precisely the point. The 401k is a bet that future tax rates will be equal to or lower than current rates. The Roth IRA is insurance against the possibility that they will not be. Most people choose one account based on which benefit sounds better in a brief description, the tax break now or the tax-free withdrawal later, without working through what either choice actually costs over a full career. The question worth sitting with before making that choice is simple. When do you want to pay the tax? Today, when the rate is known, or later, when it is not? Everything else in this decision follows from an honest answer to that question.